Well, Neo Super is an independently owned specialist SMSF administrator, and it says the Division 296 bill, which imposes an additional 15% tax on the earnings of superannuation balances exceeding $3 million, is a bad policy in many respects. To tell us why, Neo Super's Director of SMSF Technical, Nicholas Ali, joining me now. Nicholas, we've spoken quite a lot about this topic. In Neo Super's view, what could have been done differently and what don't you like?
Very simply, what probably could have been done is make cashing compulsory. So rather than have this convoluted system whereby we have a proportion of earnings above a number, $3 million, that's then subject to this extra 15% tax, probably the simplest thing should have been bring back the way things were pre-1 July 2007, and that was as soon as you reached 65 back then, you had to start taking some money out of superannuation, and that would have been the simplest thing to do, to bring back compulsory cashing. What we don't like about this tax, well, I guess there's three key things we don't like about this tax. Number one, it taxes unrealised capital gains. That's something that's never occurred in Australia. In fact, it's never occurred anywhere in the OECD, is the taxing of unrealised capital gains. We also don't like the fact that it's not indexed. So it starts at $3 million. As we know, with inflation, $3 million in 10, 15, 20 years' time is going to be a much smaller number in real terms. So that's the second thing we don't like. And the third thing we don't like is that losses associated with Division 296 can only be offset against future gains with Division 296. You can have the situation where somebody in 1 year pays Division 296 tax, in another year pays Division 296 tax, and in that third year, they actually have a loss associated with their investment earnings. They can't claw back the Division 296 tax that they've actually paid. So if they then went and sold that asset, potentially they've paid Division 296 tax that they've incurred a loss on. So they're the key three things we don't like about it. And probably the fourth one is it's just so confusing.
It's just so what you cut out there, Nicholas. So what?
So confusing.
Yes.
It's a very convoluted way of targeting what is a very small cohort of people, that when you read the explanatory memorandum that accompanied the bill, this is to go after baby boomers that have too much money in superannuation. So it's a very convoluted way of taxing those people.
So on that point and the confusion, what in your mind potentially needs to be done to make superannuation less confusing, more user-friendly, more adaptable?
I think what we need to do is strip out the politics from superannuation and get back to the knitting of the purpose of superannuation, which is to provide retirement benefits to members. I think we've got to remember that there are a lot of people that have followed the rules with superannuation. They've done the right thing. Now they're going to be punished, especially primary producers, people with farms and business real property and superannuation. They've followed the rules, and now with this Division 296 tax, they're going to be unfairly impacted. So what we would like to see is, ultimately, we would like to see the legislation repealed, and we go back to the drawing board and start again. Perhaps a better thing to do and a better way to do this is, rather than have this arbitrary movement in somebody's total super balance over a period of time and tax unrealised capital gains, we think a more fair system would be to tax actual gains, where a fund can determine somebody's actual gains, so like an SMSF, where you can determine the gains attributable to an individual member. And where a fund can't do that, like a large industry fund or an APRA-regulated fund, perhaps a deeming rate would be better to smooth out the tax over a period of time, rather than have this sort of boom and bust cycle, which potentially could happen with Division 296 tax.
Let's get to the other potential bill, the draft regulations to modernise legacy pensions. What sort of flexibility can this give SMSF, members?
Well, these legacy, as the term suggests, these legacy pensions are no longer fit for purpose. A lot of them were done pre-1 July 2007 to get people under the RBL limits, also done potentially for Centrelink purposes. But what this does is it gives people the ability to commute or roll back, cancel a non-commutable pension. invest that money in an income stream that is more flexible, that gives people the ability to access lump sums from those benefits. It also, which I think is a crucial thing, and the industry didn't realise that this was going to be part of the proposal, and that is to take reserves associated with these income streams and allocate them to the member. Because what potentially was happening is when a member passed away, these reserves would be stuck in the fund, and they can only be taken out on the drip in very small amounts without it then counting against the member's concessional contribution. So what this does is it gives the relevant member the ability to cancel the pension, take those reserves, allocate those to the member benefit, and then the member can have a more flexible pension, like an account-based pension, or they can take out a lump sum. So it brings these legacy pensions into the current era and gives people greater certainty and greater flexibility with their retirement savings.